In 2010, 10,000 Bitcoin were exchanged for 2 pizzas. At the Bitcoin price, at the time of this recording, those same 10,000 Bitcoin would represent roughly $633.8 million. Yes, 2 pizzas. But before you say somebody made the worst financial decision in history, there's much more to that story, because that pizza purchase helped prove something important. Bitcoin could actually be used. So, what exactly is Bitcoin? Why does it have value? And how did we get from 2 pizzas to a globally traded digital asset? Let's break it down in plain English. Welcome to the Crypto Prynsis podcast presented by the Carlyle Blockchain Group. Educate, empower, elevate. No one gets left behind. Before we begin, this content is for education only and is not financial advice. Always do your own research. Because we're looking at historical prices, remember, past performance does not guarantee future results. In episode 1, we learned what blockchain is. Now we're moving to the next lesson we promised you, Bitcoin. Bitcoin can refer to the network, while Bitcoin is also the digital asset transferred on that network. Unlike the US dollar, Bitcoin isn't issued by the Federal Reserve or another central bank. Bitcoin was introduced under the name Satoshi Nakamoto. Satoshi is a pseudonym. In 2008, the Bitcoin white paper described a peer-to-peer electronic cash system. Then, in January 2009, the Bitcoin network began operating. There was no central bank creating Bitcoin and no company controlling every transaction. Today's crypto word of the day is scarcity. Scarcity means something has a limited supply relative to demand. Think about beachfront property. People can build more houses, but they cannot create an unlimited amount of beachfront. Bitcoin creates scarcity through software rules and was designed with a maximum supply of 21 million Bitcoin. Scarcity by itself does not guarantee value. Something can be scarce and still have very little demand. Price depends on what buyers and sellers are willing to exchange for it. So, how do new Bitcoins enter circulation? Through a process called mining. Bitcoin miners use specialized computers to compete to add blocks of valid transactions to the blockchain. The successful miner can receive newly issued Bitcoin called the block subsidy, along with transaction fees. Mining also plays an important role in securing the network. Bitcoin has another feature called the halving. After every 210,000 blocks, roughly every 4 years, the block subsidy is cut in half. The rate at which new Bitcoin enters circulation decreases over time until the maximum supply is eventually approached. Let's put that in plain English. Dollars exist within a government-managed monetary system. Gold is physically scarce because finding and extracting more gold takes resources. Bitcoin creates digital scarcity through software rules. That's one reason you may hear people describe Bitcoin as digital gold. But that's a comparison, not a guarantee. Bitcoin and gold are different assets with different histories, risks, and market behavior. At the time we're recording this episode on August 13th, 2026, Bitcoin is approximately $63,380. That number can change quickly because Bitcoin trades around the clock. Each candle represents price movement during a specific period. A green candle generally means the price closed above where it opened. A red candle means it closed below where it opened. The thin lines above and below are called wicks. A chart tells us what happened. It does not tell us with certainty what happens next. Now, let's do something that really puts Bitcoin's history into perspective. Around November 2011, when Bitcoin traded near $2.54, $100 could have purchased roughly 39 Bitcoin. At today's reference price, that hypothetical purchase would represent roughly $2.5 million. Using a reference price near $1,007 in November 2013, that same $100 would represent only about $6,300 today. Using a price near $652 in July 2016, it would represent roughly $9,700 today. At $10,000 per Bitcoin in late 2017, a $100 purchase would represent about $634 today. Around Bitcoin's first move through $50,000 in 2021, $100 would represent only about $127 today. These are hypothetical examples using approximate historical reference prices, excluding fees, taxes, spreads, custody costs, and other expenses. Now, here's the lesson I really want you to understand. Those numbers do not mean Bitcoin was easy money. Bitcoin didn't simply go straight up. It experienced enormous rallies followed by severe declines. People have made money in Bitcoin. People have also lost money in Bitcoin. History is not a promise about tomorrow. On May 22, 2010, programmer Laszlo Hanyecz exchanged 10,000 Bitcoin for 2 Papa John's pizzas. At the time, those 10,000 Bitcoin were worth roughly $41. 10,000 Bitcoin, 2 pizzas. 10,000 Bitcoin multiplied by approximately $63,380 comes to roughly $633.8 million. Divide that between 2 pizzas, and you're looking at roughly $316.9 million of today's Bitcoin value per pizza. But I don't want you laughing at Laszlo. There's a bigger lesson here. That transaction helped demonstrate that Bitcoin could be exchanged for something in the physical world. Bitcoin wasn't just an experiment between computers anymore. Someone had used it to obtain real goods. So why would someone pay tens of thousands of dollars for 1 Bitcoin? There's no single answer. Supporters point to its limited supply, global network, portability, divisibility, and the ability to hold Bitcoin directly. Ultimately, Bitcoin's market price comes from buyers and sellers. If demand rises relative to available supply, price can rise. If demand falls, price can fall. Scarcity does not guarantee appreciation, and Bitcoin remains a highly volatile asset. If you're going to learn Bitcoin, you also need to understand security. A Bitcoin wallet helps you interact with your Bitcoin. A public address can be used to receive Bitcoin, but your private key is what allows transactions to be authorized. Many wallets also provide a recovery phrase, often called a seed phrase. That information must be protected. Never give your private key or seed phrase to someone claiming they need it to help you. Be suspicious of anyone promising guaranteed Bitcoin profits or telling you to send cryptocurrency so they can double it. In crypto, security is part of the education. Why does this matter to you? Because Bitcoin introduced the world to a different model of digital ownership and value transfer. You don't have to own Bitcoin to understand it. Understanding it helps you separate information from hype. If Bitcoin keeps appearing in finance, investing, payments, technology, and the global economy, understanding it gives you an advantage. It's time for myth versus fact. Myth: you have to buy one whole Bitcoin. If one Bitcoin costs tens of thousands of dollars, that does not mean you must spend tens of thousands of dollars to own Bitcoin. Fact: Bitcoin is divisible. One Bitcoin contains 100 million smaller units called Satoshis. Whether someone should purchase any amount is a personal financial decision. Education comes first. Let's recap. Number 1, Bitcoin is a digital asset operating on a decentralized network with a maximum supply of 21 million Bitcoin. Number 2, Bitcoin uses mining and network rules to process transactions, add blocks, issue new Bitcoin, and help secure the network. Number 3, Bitcoin's historical rise has been extraordinary, but so has its volatility. Past performance does not guarantee future results. Now that you understand Bitcoin, we're ready for the comparison everybody asks about. Bitcoin versus Ethereum. Are they competitors? Do they do the same thing? Why does Ethereum have smart contracts? And why choose one network over the other? The financial system is changing quickly, and understanding the language now can help you make better informed decisions later. Remember, the future isn't waiting for anyone. Learn it, understand it, own it. Here at the Carlisle Blockchain Group, no one gets left behind. I'm Crypto Princess, and I'll see you in the next episode.